wanted to welcome you all to the next installment of our Market Matters series. For today, we were able to find another solid guest speaker in an area of the market that we think is really interesting right now. His name is Charles Anderson. He's a portfolio manager with Invesco's SteelPath Energy Group. And given the significant volatility in that part of the markets, we thought his voice would be a timely one to add to the investment discussion. From an expectations perspective, these series that do have guest speakers run a little bit longer. So we're anticipating somewhere between 30 and 40 minutes potentially, as opposed to the regular 30-minute session. Returning to the agenda, we go through the fact pattern here for COVID-19 real briefly, touch on some economic and investment implications, and then turn it over to Charles. And I think you'll see there's also a few new slide formats in there that I think you'll find interesting. At the end, we'll turn it over for some Q&A and then call it a day. So with that, let's get started. So this is a great data series. Again, I would encourage everyone, if you're interested, to go to the Bloomberg website that focuses on COVID and new infection rates. But you can see global cases added per day. And, you know, I think this is a instructive chart because while here in the US, we are contemplating certain areas of the country to be reopening or having reopened in some limited scale, it's still a very mixed picture globally. And what I mean by that is you can see it does appear that global cases added per day is actually starting to increase a little bit. That's a bit of a challenging dynamic, of course, because now COVID is into some of the emerging markets right now, and it's taking hold, like in Brazil, Russia, and others. And also in the US, with one of the better healthcare systems in the world, we still are having more of a plateauing as opposed to a decline that you're seeing in other countries like Italy and Germany, Spain, continental Europe, and the like. So this suggests a couple of things. One is that the longer that this plateauing occurs as opposed to decline, it just raises the risk for a second wave becoming a much more plausible scenario as occurred back in the Spanish flu pandemic of 1918, 1919. But again, we still have a lot of time to go before that happens. It's just raising the probabilities. So unfortunately, that is the case for right now. There is a great, right before this webcast, one of our clients sent me a great blog post about you know, some of the precautions that we still need to take even in these kind of limited opening periods. And we could definitely circulate that as part of the follow-up to this particular discussion. And that's about all I'm going to say for the COVID side. You know, still not a lot to report in a good way. I mean, certainly the virus antigen formulations are occurring pretty rapidly. Gates Foundation now is upping their estimate from a time frame from, I think it was January of next year for a vaccine to now it's September. So that's very positive. And I think we are going to get a vaccine. Question is, you know, can we mobilize to the scale we need to get that vaccine out in a way before the second wave hits? And that's kind of a real question mark right now. Turning to some of the investment implications or economic implications, again, we still are looking for that 3,000, 2,500 to 3,000 mark on the S&P to do another rebalance for client portfolios. I did breach the topic here of inflation, and you know, there is some data to suggest that this is something that we should be thinking about, of course, with all the debt issuance that's occurred to stave off some of the economic devastation that COVID has wreaked on the economy. But I guess the main point here is that inflation still appears to be somewhere in the neighborhood of 3 to 4 years out. Equities, on the equity side, you know, active management is having a really interesting dynamic this year, particularly if you're aware of, you know, growth versus value dynamics, but also sector dynamics, which I pointed to, and I will point to here in the earnings picture. There are, you know, a number of large cap growth strategies this year that are up, that are actually positive by a pretty decent amount versus large cap value, which is continuing to have some issues. And just from like, what are we doing on our end? The Gratus Investment Committee just recently approved a new active large cap growth mutual fund strategy for a number of our portfolios which will be taking or sourcing those funds from indexes. And I do think we are approaching a time very similar to 2000, where index investing will be very challenged, and active strategies, as we're seeing already, will be one of the few ways to generate a positive return in this market. On the fixed income side, credit, again, bond markets are showing a bit of a less attractive risk-reward proposition than they were in prior weeks. And we continue to look for ways to high grade or increase the quality of our bond portfolios. Because again, we don't want to be taking a lot of risk here, especially with some of the massive deflationary shocks that are coming our direction. On the alternatives front, just some updates here. I had mentioned a few weeks ago, we were looking at the REIT space. The REIT space, again, is turning into a situation where it's a tale of two cities, if you will, where there are some sectors like the industrial portfolio sector or industrial logistics real estate side is doing pretty well. Same with certain healthcare segments. Whereas and opposed to that, you have things like retail and mall centers doing pretty poorly. So we identified a great new active REIT strategy. Again, not an index, but an active REIT strategy that we feel really confident about in the current environment. So that's kind of what we're doing here on the investment side from a positioning changes standpoint. We did add this slide because I know I've heard from some of you to say, hey, well, these are great ideas. What are the actual thinking on various parts of the market? And certainly I would suggest you can flip through the slides when we've concluded these remarks. But I just wanted to lay out to you kind of a summary view of where we're seeing attractive opportunities in what various sectors of the market. So like U.S. stocks, we've laid out our position on large cap, mid cap, small cap, international stocks, developed markets and emerging markets, the bond segment, and then the alternative segment. And, indicating here, of course, was a previous view and an upgraded view, or if this were the other way, it'd be a downgraded view. So you can see, just generally speaking, still have a very big preference for large cap, particularly, those large cap companies that have an ability to operate in an asset light model. International stocks have gotten a bit of an upgrade here recently because of the divergence in performance between the U.S. and international. Emerging markets are still a bit skeptical of, I guess is a good word to use, but we still have some exposure through active strategies that we like. On the bond side, again, this is where the picture gets very tricky because there are parts that we don't like at all right now, meaning junk bond market, emerging market bonds. And there are parts that we actually do like now, like municipal bonds. Would you believe that municipal bonds in a lot of areas of the country, and I touched on this in the comments from last week, but are yielding more on a pre-tax basis than both governments or high quality bonds of similar credit rating. So a AAA bond on the corporate side yields less than a AAA bond on the muni side in some cases. And those are dynamics we definitely want to take part in, where we can see those real big discrepancies or anomalies. And then the real asset side, this is really just, and I think this would really fall into what Charles will talk about, and that is things that are attached to the energy sector right now, like the pipeline sector potentially, real estate or real assets would all, I think, have an upgraded point of view because now inflation could be coming in the next 3 to 4 years potentially, but also the valuations are suggesting that they might be an interesting place to start looking at. So these are just some high frequency data points, meaning not put out by the government, that are issued on a weekly basis, similar to the TSA number of check-ins that I showed last week. This is an interesting one. It says the number of searches done through Apple's mobility application. So if you go pull up Apple Maps and you put in your location and where you want to go, that's a search. And you can bifurcate that search between a transit system, driving directions, or walking directions. And it does appear that, the transit systems, because of all the issues with close quarters, are not getting searched at any greater level than they were when at the start of this crisis or lockdown. But what is starting to improve are things like driving search queries as well as walking search queries, which is actually great, because then maybe that might make, in some small way, our nation a bit healthier, as opposed to suffering from some of the obesity problems. But regardless of that, my point here is that unofficial data is showing some change in consumer behavior, not relating to either both transit or now starting to feel like we can get out and travel a little bit more. And I think this is just emblematic of the reopening is starting to occur. This was an updated slide, I thought, that pulled in some of the data around market timing and why we think it's really a bad idea to try to exit the market in certain times and then try to get back in. And the reason is because for two. One is that the best days usually are always following the worst days. And you can see this goes back to the 1950s, by the way. This data set goes back pretty long. And that's one reason. Number two is, believe it or not, the 1 year return later in both cases is usually fairly positive by above 20%. So, I think this does speak to the question of, should we sell now, take some profits off the table, just hang out in cash for a little while? And I think that's just a really difficult process to engage in, because best days are followed, the worst days are always followed by some of the best days, as the data would suggest, but also the forward-looking return 1 year later is generally pretty positive. So I definitely wanted to touch on that, a quick update that we found. Here's something that's been talked about in the media recently that I think is getting a bit more traction. And I showed our investment team a chart of what they call the Fed funds futures. The Fed funds futures is basically a prediction market of where the federal funds rate is going to be at some point in the future. And usually the futures exist for time periods of 2 years or less. So there are futures that would exist now out to June of 2022 or May of 2022. So interestingly enough, I looked at the Fed funds futures, and June of 2021 now is when the market now expects the federal funds rate to be negative. And I know that's a canary in a coal mine for a lot of people. It can be very problematic. But if you run back through the data of when we've had real negative Fed funds rate, so you're basically taking the Fed funds rate and subtracting inflation. The times when, let me orient you to the chart here. This is the S&P's return on the vertical axis. On the y-axis, this is the average of the trailing 12-month federal funds return rate, which basically means if you were to look back over the last 12 months, what was the average rate of the real Fed funds rate? So that's on this. So so starting on the left side, this is negative. On the right side, this is positive. You can see in each quadrant the frequency of these occurrences, and then also the S&P return at those points thereafter. So I think what's interesting is that when we get into the negative rate territory, which hasn't occurred very often, by the way. I mean, you can see negative Fed funds rate has occurred only in real terms, only about 32% of the time. The other, 67% is positive. But when that happens, by and large, the forward-looking average return 12 months later is 13% for equity. So my only point here is that while Europe does have a negative overnight rate, which is equivalent to the Fed funds rate, Japan has a negative overnight rate. It's not necessarily a death blow to the economy. I mean, certainly for the banking sector, it's very challenging, and that's one reason why we don't necessarily have a lot by way of banking exposure right now. But I just wanted to point this out because I've heard some people say, well, once we get to negative interest rates, that's the jig is up. And I think this would suggest that it's not necessarily that. It's kind of the negative second and third order consequences in various sectors that might be more problematic as opposed to the S&P, which is now tilted much more heavily to technology. And then just a quick earnings update. There have been a few more earnings companies that reported earnings over the last week. And you can see kind of the result here. I think it was negative 13.5 last week when we checked. Now it's negative 13.6. And I just wanted to show this as it relates to how and why we think active approaches now stand a good chance of performing in the current environment versus passive approaches. Because again, if you can allocate capital to the sectors that are actually showing earnings growth, as opposed to avoiding and avoid the sectors that are showing earnings contraction, then that has a way of bubbling up into stock price performance that can be very different in the index. And I think that's what you're seeing now with actually the NASDAQ 100, believe it or not, is positive year to date by about 6 or 7% versus the S&P, which is down about 7 or 8%. So let's see here. And then, I have heard a number of stories about how the economy and the stock market are diverging pretty mightily. The gap between the two is widening out. And my only comment on that would be to say the stock market is not representative of the economy. And I think that shows in a number of different ways all across the world, particularly if you look at things like emerging markets that have very high growth, but they also can have very negative stock performance because what also it comes along with some of these emerging market areas is inflation. But this is just a year-to-date picture through last Friday. You can see the gap continues to persist here through with international companies being the green line. The pink line is emerging markets. The B is cut off there. Sorry about that. And the red line is the S&P 500 down about 8. Interestingly, the small cap stock index, the Russell 2000, has caught up a decent amount. So now it's only off from the S&P about 12%. But still, that difference is something that we wanted to highlight because we have very little exposure there. One kind of interesting thought experiment to just throw out there is that, everyone in the media likes to talk about how buybacks have been the only source of capital that's been propelling this market higher. And I would say they certainly have contributed, but to say that they have been the only contributor to aggregate demand for equities is just patently false. And I think you can see that, yes, that buybacks do tend to follow the ebbs and flows of the S&P itself. And that kind of makes sense. When challenging economic conditions come into play, companies tend to conserve capital. But we've had a huge move from down 30%, 32% in March, February, March, to now only down 8, with the NASDAQ actually positive for the year, while buybacks have done almost nothing this year. And I would say there are incremental buyers out there, and just think what might happen when buybacks do return in any significant way. That would represent a significant amount of incremental demand that currently isn't there. So that's maybe one tailwind that a lot of people aren't thinking about right now. Fixed income, again, this is just a graphical depiction of what's going on in the markets there. The red market, a red line being the government proxy for the government bond market. The blue line there is the LQD, it's the investment grade bond index. Green line is the junk bond index, and the pink line is the emerging market bond index. Yes, there's been a little bit of recovery in some of these tertiary areas. We still think they are highly exposed to economic fragility, and we continue to find those unattractive. The Fed has supposedly been buying the LQD and corporate bonds, but you can see that benefit of their announcement is starting to taper off. And so we'll see how low this decides to go. But a lot of this is what's making the bond market a bit tricky to invest in right now. And then this is that chart I was telling you about, when should we expect inflation to come? It just shows two things. One is the civilian labor force growth rate. So the meaning, like how many, what's the growth rate in the working age population, essentially. And then overlaid that is the CPI, or Consumer Price Index, 10-year compound average growth rate. This is the right-hand side, the CPI index, which is representative for inflation. This is the labor force growth rate. And you can see, I think it's a pretty tight correlation, because as the civil labor force grows, that's when you start to get inflation, because more people are working, earning decent wages, and they're putting upward pressure on prices. But it's important to note that this time series is a 4-year lag. So only after the civilian labor force workforce starts to increase in numbers, 4 years later, on average, is when inflation has started to come back in any sort of way. So that's just something to keep in mind, and kind of the way we're thinking about inflation right now. So, just to sum it all up before we hand it over to Charles here, there is, we still continue to think that our best estimate or highest probability would be that we get some sort of a retest in the neighborhood of the March lows this year. We don't know exactly when or what's going to kick it off, but that certainly does exist. Maybe it's something to do with the second wave or something along those lines. Earnings have come in much better than expected. As I mentioned last week, some sectors are performing much better than others. We want to identify those and attach ourselves to those in any way we can. Index investing is becoming a lot less attractive with return dispersion rising, and traditional methods of identifying growth and value need to be revised. So with that, I'm going to pause here just for a minute and let's see if we can get Charles on the line here. Charles is as I mentioned, he's a portfolio manager with Invesco SteelPath. He oversees some portfolio strategies for Invesco in the energy sector. And I just wanted to turn it over and see if we can get Charles on here. Charles, are you with us?
Yes, I am.
Awesome. So just for the group's benefit, if you would, well, first of all, I did put some of your slides in here, so we can definitely speak off that. But if you wouldn't mind, real briefly, give the group an overview of kind of what you do over at Invesco, and then maybe your firm's perspective on the energy markets.
Yeah, absolutely. So we work with Invesco funds. We're employees at Invesco, and basically we are managing mutual fund and other strategies and invest in the midstream energy space. So when you think of energy always kind of sits in three states. It's either in the ground, which is upstream, and those companies are Exxon, Chevron, BP, the companies that actually do the production, they own the commodity. Midstream is the transportation. It gets it from the oil fields, from the gas fields, from the plants to the consumption side, and that's the downstream. Downstream would be a refiner or maybe a utility facility like Georgia Power or Southern Company, somebody like that, Duke Power, that would buy the commodity. So midstream kind of connects the two. So basically it's a must-run link inside of the energy chain. You can't produce and you cannot consume without these companies. They own and operate the pipelines, they own and operate storage facilities, export facilities. They're the companies that move the energy in the United States and eventually to the world. They'll get it to the export facilities. So we basically just manage a group of strategies that invest in these publicly traded companies that own and operate the midstream. We find it very, very valuable. As Todd mentioned earlier, he showed you the real assets and how he kind of felt that the real asset side of the business or of the sector of the economy was attractive right now. These are hard assets and they're must-run links inside of the energy chain, and they're severely undervalued. You're looking at what these companies are worth, and they're trading off as if their business is just diminished, which really isn't the case. I think a lot of it's just kind of misunderstood. When you invest in the market, there's three things that will make the market go up and down. Basically, that is sentiment of how people feel about stock markets. And then there's technical, which are kind of just algorithms or a process that you'd use to trade. You don't really look too much at the companies or the fundamentals. And then finally, there is the fundamentals. And fundamentals is really what makes the stock move. Fundamentals are companies making money or are they not making money? And that's where we kind of find the value of midstream energy today is we're seeing these companies, they're generating cash flow, they're doing quite well, but yet their stock price is cheap. They're not trading in line with what they're worth. So that's why we see value, and that's why Todd mentioned earlier that they see value as well, is that you look at assets that are cheap right now, but yet fundamentally you need these companies around. So kind of shifting a little bit, let me just talk about the upstream. Let me just talk a little bit about what's going on inside the energy space. it's going to be tough. The second quarter is going to be a little bit tough. This time from May and June and a little bit in July, because you basically, energy production is not a switch. You can't just turn it off and then turn it back on. It takes some time for it to wane, and then it takes some time to bring it right back up online. And I'm usually a matter of months. So if I stop drilling a rig, if I stop that rig, it will take about 6 months for that well to start slowing down production. And then to get that production back online, it's going to take me another 3, maybe 4 months to get that production back going. So things don't move quickly inside the energy space. So for the second quarter, you're going to still see companies have some production, as you've got these older wells that are still coming online. You can't really shut them off. You can't really just cap them. So there's going to be some more production, and that's kind of what we don't need right now, is you kind of got to reduce our supply. So what's going to happen is you're probably going to see a little bit price movement downward of the commodity price. But over time, that's going to have a bigger impact, because companies are starting to slow down their production. So we kind of think maybe around June, July, we'll start to see some production shut in. And in the industry, production shut in is not turning it off, you're just slowing it down. So instead of producing 1,000 barrels a day, I'm only going to produce 500 barrels a day. So you're just kind of slowing that well. You can't really put a cap on it, because sometimes when you do that, the well will cave in on itself, and now it's worthless. And so you've got to keep some production going. So you just try to limit the amount of production that's going to happen. So we estimate we'll probably have about 3 to 4 million barrels of crude oil that shut in the United States during the second quarter. And then we kind of think prices will start to rise back up to maybe around that $30, $35 barrel, and you'll start to see that production pick back up a little bit from there. But the U.S. is going to be this year a little bit less on production than what we were last year. It's estimated we'll probably produce about 11.1 million barrels per day. Last year, we produced 12.8 million barrels per day. So that's a pretty big decline coming off over 12 months. But there's still going to be some demand picking up, we feel, later this year. Most analysts, we kind of thought the worst month for this whole period would be May. And now we're starting to see that maybe April was the bottom. Todd had a neat little chart of the Google Maps or the Apple Maps that showed that people are starting to, it's kind of an indication that driving is picking up. And you're starting to see that with the companies we own that are moving gasoline and diesel. They're seeing more volume start to pick back up. So we kind of feel that April was probably the bottom. And if you want to put a date on it, it was probably April 12th or April 13th was probably the lowest point demand got, and then demand has been climbing ever since that April 12th, April 13th date. So that's a positive, because the more that we're moving, the better it is for all companies around. As far as demand goes, this is how hard it is to predict this. In late March, most analysts felt we would have about 29 million barrels of demand destruction in the second quarter. Now those numbers have been revised. As of May 7th, we feel it's going to be about 13. So we went from 29 million barrels of demand destruction to now only saying it's 13. So again, things are not as bad as what they're indicated out there. On the midstream side, again, I think you're going to continue to see this movement of crude oil inside the United States. It's going to take a while to work off these supplies, but the gasoline, diesel demand start to pick back up. Jet fuel demand starts to pick back up, and you start to get this movement again. But in the meantime, The thing that we really like about midstream is this, is that if you can't really move that much product, when there's not that much demand, you still have product coming out of the ground. You still have refiners producing product. They have to do something with it. So what do? They store it. And these companies own and operate the storage facilities. And right now, storage is at a premium. Typically, I could charge maybe $2 a barrel to store your crude oil. Now, storage rates are going for about $5 a barrel. So a lot of these companies that we own inside of our strategies are starting to see a lot of cash generation from the storage assets that they own. So again, this is why I kind of like the midstream. It's a little bit more cash flow stable. It really doesn't depend too much on the price of the crude oil to move it through the volumes. And I think we've got a couple of slides to point here on.
Yeah, I was going to say, Charles, I pulled up your first slide here just for reference. I guess this is the midstream space you were referencing, right?
This is, yeah. So this kind of shows equity issuance. So if the chart on the left with the blue bars, if you notice, there was a lot of equity issuance going back starting in 2009 all the way through 2017. So what happened was we started to produce a lot more energy in the United States. So we needed more infrastructure. We needed more pipelines, more storage facilities, more gas processing plants. So what these companies did was they paid out all their cash flow in a dividend or distribution. These companies typically have very high yields. Right now, the average yield is about 13, 14%. And they pay that out, and then they go to the stock market and they issue new shares, and they get more money to build new projects. The problem with that is that when you issue new shares, it dilutes it for your existing shareholders, which means your share value gets diluted. It becomes a little bit less valuable if there's not price appreciation. Now you can see there's very little CapEx, very little capital, or very little equity issuance going on. Midstream companies just don't need to build as much projects, and they're becoming a lot more fiscal to where they're building the projects with their own cash. They're not issuing equity. So this is a positive. They're not diluting your stock. They're actually pulling themselves up by their own bootstrap, and they're paying for it themselves. And then you see the retained cash flow in the middle. This is another positive for companies. The increase of retained cash flow means that business is doing very good. You've got this excess cash you can do something with. You can pay down your debt. You can increase your dividends or distributions. It's a positive for stock prices. And then the final on the left is the distribution coverage. And what this really represents is how well is the company able to cover their distribution. So a 1 times coverage means that I bring in $1,000 and I pay out $1,000. I've got a perfect coverage. If I'm a little bit higher than that, means I probably bring in 1,000 and I'm only paying out 700. So I've got a little bit extra cash to have a little bit more flexibility, which is what you want in these times. You want to see companies have a little bit more cushion when the future is uncertain. So you can see companies right now on average have a 1.5, 1.6 coverage ratio on their dividend or distribution. So they're more than able to fund these 13, 14% yields, and they've got a little extra left over. On the next slide, this kind of shows the valuation that I was talking about. You know, what are the companies worth? So what this chart shows is that dotted line in the middle kind of shows your fair value. You're getting the right price. You're buying a stock for this price, and most people out there say that's exactly what it should be worth. Where here you can see we're trading all the way down. We're about a 6.5, 6.4 enterprise value to EBITDA multiple. So what's that basically saying is the company should be at a 12 times. So it's trading at a huge discount. But yet the previous chart I showed you, the fundamentals of the company are completely strong. These companies are making money. They're doing all the right things. And again, this is a must-run link inside of the energy chain. Without these companies operating, there is no energy. There's no lights in our home. There's no gas in our stove. There's just no energy. So even in a recessionary type of environment, we still use energy. it has to be moved in in the country. The U.S. has a network of pipelines. We are the largest network of pipelines in the world, and we move this energy left and right. The other thing that I think people kind of misunderstand is this just isn't crude oil. This also is natural gas. And natural gas, when I started out in this industry, you always paid attention to natural gas in the winter time, because that's when you saw natural gas start to grow. That's when demand picked up. But now utility plants are not using as much coal, and they've switched from coal to more natural gas. So now you've got to look at natural gas all year round. So when it gets to be 100 degrees in Atlanta for an entire week and everybody's using their AC, that's more natural gas. And we own companies that will move natural gas to these facilities so that people like you and I have power. So with this reduction of crude oil, there's going to be something that's most likely going to happen in the United States. We are going to be at a deficit of natural gas. Our supplies are going to start dwindling. The reasoning for that is when you produce crude oil, you produce natural gas with it. It's called associated gas. And now that we're going to have a reduction in crude oil, we're going to have a reduction in natural gas in these liquid basins. So now you're going to start seeing a pickup of drilling in dry gas basins, such as the Haynesville, which is in Louisiana and Texas, the Marcellus, which is in Pennsylvania and Ohio and West Virginia. You're going to start seeing those companies start to pick up drilling, which means more volume, more movement on the pipelines for these natural gas companies that we own. So that's going to be a little bit of a positive. And the market's starting to pick up on that right now. Most people kind of feel we'll see natural gas prices rise about 60-70% before this year is out. And that's going to incentivize more drilling, which incentivizes more volume for these pipeline companies, which basically equals more revenue. So again, it's not just about crude oil. There's a lot of other factors out there as well. But
Yeah.
Again, we see companies that are very well situated financially. They've got very good metrics. They're able to weather this storm that we're in right now. Again, second quarter might be a little bit soft, but we feel we've reached a bottom. We're coming up out of that. Again, demand's going to pick back up. And then we're seeing these companies trade at a huge discount. So that's why people like Todd and companies like Gratus right now are really focusing on midstream assets and energy infrastructure, because the companies are trading very cheaply, but you can see we're going to need this movement of energy.
Yep.
So with that, I'll go ahead and turn it back over to you, Todd.
Yeah, absolutely. I was going to say, with some of the time we've got remaining, it does appear that you guys are, isolating segments of these energy markets that you do find attractive. And I would just say, within the current context of what's going on, maybe with some of the oil wars energy wars that are being waged internationally between, Saudi Arabia, Russia, and now the U.S. being brought into that mix. Where do you guys see prices heading? I mean, I know it's a crystal ball type question, but it does appear that some dynamics are setting up, as you suggest, for some longer term stability in prices. Is that kind of your go forward estimate?
Yeah, so when we build out financial models, we actually use a range of prices from energy analysts. We like to use energy analysts that don't run financial books because they don't have any money in the game. But we're kind of seeing a base case of prices basically kind of reaching that maybe that $35 a barrel by the end of this year, and then next year reaching somewhere in that $44 a barrel, because it just, there's an old saying in the energy space that low prices fix low prices. And what that means is when you have very low prices like we have today, nobody's making money. And so you start cutting back your production, you start shutting in, you start slowing it down, and then your demand starts to pick back up, your supplies start to fall, and prices start to go back up. So we're kind of thinking maybe in that $30, $35 range this year, and then next year in that $43, $44 range.
Yeah, really interesting. Just given we've seen quite a bit of volatility in the markets this year. I mean, even unprecedented things like the negative negative prices on front month contracts has just really created, I think, some really unique opportunities that have never existed ever before, potentially. Well, Charles, I do want to thank you for spending some time with us. So again, I think that does it for today. We wanted to thank you for taking the time to join us. If you do have any questions about any of the content or follow up from the items that we talked about today, please don't hesitate to contact your advisor. And if you don't have an advisor, we certainly love the opportunity to work with you. So with that, we'll see you next week, and hope everyone has a great rest of the day. Thanks.